I want to show you guys how you can start investing and building your wealth for $25, okay? Starting with $25. I know that when you hear the word investing, you're thinking these large amounts, but it literally does not take that. As a matter of fact, you can start with $1 because if you are in any platform like Robinhood or SoFi, any platform that allows you to do fraction of shares, a lot of them allow you to start with $1. And guess what? If you got Cash App on your phone, you can start there because Cash App allows you to invest in stocks and crypto for as little as $1. But I want to give you guys a breakdown to start this thing with $25. Show you where you could potentially invest. Now, I always recommend you doing your own research, but I'm going to give you guys four ETFs and indexes that you can start with. Because if you've ever downloaded an app for a brokerage account and it says something like, what is your risk tolerance? One of those ones that invests for you. It'll say moderate risk, medium risk, like excessive risk. A lot of times the either low risk also, it just depends on how they have it worded. A lot of times the low risk and the moderate risk are investing in things like ETFs that tracks multiple companies at once instead of investing your money into individual stock. So if you ever saw that, that's literally what it means. And it's probably excessive risk by going with one stock because your money is in one company versus a ETF that's tracking a bunch of companies. Okay, and we'll kind of get into what that means in a little bit. But I want to help you guys plan out a small investment strategy for yourself for the next 5 years, actually. So we're going to look at year one, and then the next 4 years, you increase the amount that you invest to the point that you get to $20,000 invested. Now, we're going to do this as a whiteboard lesson because I want to make this as simple as possible for you guys so that you will fully understand how to go about this and just how simple this thing is. Because first of all, think about it. What are you spending $25 a day on? Now, you total that by the end of the week, how much have you spent? Might have been 100, might have been 125, $150 you've been spent in a week. Now ask yourself, where did it go? Where could I have maybe cut back on and put that into a investment account? I was going to say savings, but one of the things I don't believe in is saving. The standard type of saving, okay? If you're telling me, hey, save this money, but put it in a brokerage account or put it in a high yield savings account, maybe, or something that is growing the money, okay. But one thing I've learned, baby, is that the rich do not save. And if we want to plan like the rich and grow our wealth like the rich, we gotta do things the way that they do it. That is why the Rich Are Getting Richer is one of my favorite books because I've been reading this thing since 2018. Every year since 2018, and you learn a lot about how they do things with money and how we as the everyday people, the way we grew up thinking about money is the reason why many of us do not have it. And so that's one of the things that I want to attempt to change here, even if a little speck at a time. And that speck is going to be that $25 that I'm going to show you guys how to invest. Now let's get into the numbers, okay? So we got $25 a week that we will be investing, okay? And let me say this, automate the process. Automate will be the biggest word of this entire thing. Automate it. Don't go in and do it manually. Go in and set it where this is a recurring investment that it goes on its own so that you're not second guessing when it's time to send your $25 to your brokerage account. You're not pulling back. You're not skipping a week. Automate that $25 so that you do not find yourself pulling back on that week's investment. All right. So set that thing up as a recurring investment. You should be able to do that across all brokerage platforms. The next number that we will look at is $100 a month. That's how much you've been invested on the month. Now, think about what you're paying $100 a month towards that could potentially be cut in half, or gather up everything that you're probably paying right now that's not a necessity and figure out where you can cut back and allocate that $100 a month. I always break things down when you are attempting to put into anything, okay? Now, we're going from low to high, but when we look at how much that'll be on the year, which is $1,300, invested in 1 year. So instead of looking at it like $1,300 invested or $100 a month, it's $25 a week. Break it down in whatever numbers that you may need to break this thing down to make it not seem so big in your mind. But when you are investing in anything, nothing's too big, okay? Because the more we invest, the higher our reward has the potential to be. And we'll talk about that in a little bit, okay? So $25 a week, $100 a month, and $1,300 a year is what we would invest in if we were extremely consistent, not missing a week on that 25. Before we get into the next part, I want you guys to think about this in a 5-year time span, okay? Because that is where you'll really see your results over the course of 5 years. Now, I started this $100 a week into 4 different ETFs in 2020 when the market was really down, on top of a bunch of other stocks that I selected and that I have been investing $100 in every single week since 2020. So let's look at this thing in a 5-year perspective. Let's just imagine you decide to do this for 5 years straight and you doubled up every single year. Year one would be $25, and that would equals $1,300 a year. Okay, so you would have invested that first year $1,300. That doesn't include any gains or any dividends. All right, year two would be $50, where you're taking it up a notch. It would be $2,600 that you would have invested. Now, year three would be $75. And this now would be $3,900 that you would have invested for the year. Okay, we're taking it up a notch every single year to continue our growth. Now we at $100, okay, and that's now $52 a year. And then we're at year 5, which will be $150. Now we're really taking it, instead of 125, we're taking it up a bit now. And now we're at $78 a year. When it's all said and done, by the end of those 5 years, you will have invested $20,800. Now, tell me what you are spending this amount of money on in the course of 5 years. It could be even more than that. Now, I'm not talking about necessities. I'm talking about stuff that we just really don't need, or stuff that can be slashed in half to achieve this number in 5 years. Okay. Now, again, this does not include any stock gains. This does not include any dividends. Okay. Imagine you were to be able to do this in 5 years, and as the years progress, the things that you're invested in are up 10% on the year, 15% on the year, 20% on the year. In 5 years, it's up 25% on the year. This number is steadily growing with the things that you are investing in. I hope that makes sense, and I hope you guys are writing that down, okay? So let's take all of this off, and now I want to introduce you guys to 4 indexes, 4 ETFs that I want you to be able to focus on, because when you are new to the game of investing, you don't want to try to focus on a bunch of individual stocks. Now, I could recommend a few for you guys that I do really like, that are growth stocks, and then probably some companies that you use every single day. The key to those is getting in at the right spot. But instead of that just yet, I want to introduce you guys to 4 ETFs instead. Okay? Now, with these ETFs, they do pay dividends. This is one of the biggest things that I recommend for beginners, is to find things that pay dividends so that you're getting paid to simply hold the stock. Now, just because you get fractional shares, that does not mean you don't get no dividends. You just get fractional dividends versus the whole thing. And dividends are simply just what shareholders are rewarded for holding a company's stock. And for ETF means exchange traded fund. Okay, ETF tracks a number of companies, and it's just one company itself, or one stock. So instead of investing just directly in Apple, you can invest in ETF that includes Apple and alongside other companies that may be in tech or just a bunch of different sectors. Okay, so these things are moderate risk because they're not just one individual stock that you're putting out your money into. You are able to see your investment move with the movement of a ton of companies at once instead of just relying on one company. That term, don't put all your eggs in one basket, that's what we're talking about. You put your money into ETFs and you can do individual stocks, but you're not putting all of your money in one. So let's look at the four. The four will be VOO, which is one of my favorite, VTI, SPY, and QQQ. These four are the ones that I have been investing $100 into since 2020, because what was happening during 2020 when that coronavirus was spreading like wildfire, everybody was in the house, market was down, the consumer sector was really down, and it was putting a lot of pressure on the entire stock market, and everything was down. Now that was the perfect time to start investing. That was the perfect time to start snatching up a lot of those companies while the prices were low, because as the market began to rebound, so did those stocks. And don't worry, I ain't gonna leave y'all hanging on what these four things are. All right, so let's look at it really, really quickly. VOO is a S&P 500 tracker. Okay, this one here is one of my favorites simply because of the dividend that this thing pays out. On an annual basis, you can expect around $7 in dividends. Now, I know that may not seem like a lot, but of course, the more you have invested, the more you get paid in dividends. So when you have full shares of these companies or just VOO, you're getting a full dividend payout. And the more shares you have, the more you're getting paid, okay? And we're going to look at what those dividend yields are in a moment. Now, VTI is a total market tracker. Okay, and what that means is that VTI tracks the entire U.S. market. When you invest in VTI, you are pretty much investing in the performance of the overall market. Now, there are some big dogs and there are some, underdogs down there, that the big dogs have the ability to move the market, and they can also play a huge role into the performance of VTI. Same thing with VOO. But overall, it's tracking the entire market. Now, VOO tracks approximately 500 stocks, because the S&P 500 is what? It tracks 500 companies. Now, it may be a little bit more because some companies have multiple. They have multiple listings, like Fox. Fox has a Class A and a Class B. Berkshire Hathaway has BRKA, BRKB. Google has two class stocks, GOOGL and GOOG. Okay, so there may be a little bit more there in there, but overall it's 500 companies. And then you have Mag 7, who has a huge impact on the S&P 500. Okay, so SPY is the S&P 500, and it tracks 500 of the top companies in the world, and they recently just added a couple of companies, with SanDisk being one of them. The hard drives, they just added them to the index. So you will occasionally see that the S&P 500 will add to its index. I won't be surprised if the name changed one of these days, but sometimes they'll take companies out when they no longer meet their criteria, and then they'll also add companies in, okay? And watch companies that the S&P 500 adds to their index, because these companies tend to have a really nice rally when they are added to the index. But don't go too hard on it, but that's just something I wanted to put out there for you guys. Now, QQQ. QQQ is tech heavy. This is why it's one of my favorites, because I am in tech. My startups are in tech. And so I wanted to be able to be in that tech space without having to go invest in every individual tech company. Do I have some out to the side? Absolutely. But QQQ is where I would go the hardest, so that I'm not putting all of my money individually into all of these tech companies. Although I do have, I want to say, exactly 16 total tech companies individually, and then QQQ is what allows me to get into tech without having to go into all of them individually. Okay, now with QQQ, think about it. If it's tech heavy, if the tech sector is down, let's say Apple is down 20%, Tesla is down 20%, Meta, let's see, who else we got? AVGO. Let's say all of the tech is just down. Let's say it's in bad territory. QQQ could have the impact, can feel the impact of that and it could start coming down, because if this is a tech heavy ETF, it's going to react largely to the tech sector being down or being up, whichever way it decides it wants to go that week, that month, that year. QQQ will feel all of that. Now, S&P 500 has the most impact from Mag 7. Okay, Mag 7 is Apple, Tesla, Nvidia, Amazon, Meta, Microsoft, and Google. Now, Google is called Alphabet. That's their parent company, okay? So it would be Alphabet, which you'll see, but Google's ticker would be GOG or GOGL. All right. So that's Mag 7. Mag 7 are the big dogs in the market. These are $1 trillion market cap companies. They have the ability to move VOO, but they mostly have the ability to move SPY. Okay. Mag 7 are the magnificent 7 that are on the market. Now that we've got that out of the way, I want to use VOO as our, let's just say that's the first company or first ETF that you decide to put your $25 into. And I want to look at some numbers. All right. I like to crunch numbers. Okay. I'm a numbers girl. I like crunching numbers because that's where the money is. When you're able to break down the numbers, you're able to understand how to efficiently invest. Now, let's get down to VOO's numbers. Now, for those of you who are new, VOO is the ticker. Okay. But this company or this ETF is Vanguard SP 500 ETF. And you'll probably see Vanguard a lot across the market, okay? But VOO is just Vanguard's S&P 500. And I put a B, but that's a P. SP 500 ETF, all right? So let's get this off here. And we are going to start crunching a few numbers with this thing, all right? So with VOO's price as of right now is $635 as of Friday. Okay, so we're looking at putting in $25 as our starting point. You see how it's like a drop in a bucket on this particular stock, and you of course will need to be investing to get a full share. But that does not mean that you cannot reap the benefits of this stock or this ETF moving. Okay, now on average, VOO sees about 10% growth, okay, on average. But the last 5 to 10 years, however, we're looking at this thing more short term. Remember, we looked at this thing from year 1 to year 5. So I want to focus on the first 5 to 10 years, which is approximately 13 to 15% growth. Okay, so if VOO has the ability to grow 13 to 15%, then that just gives you an idea, a little bit of perspective into how your money can grow year on year over the next 5 years. Now, here's the fun part. This is where you're getting paid to even have even the smallest investment in VOO or any dividend paying company or ETF. On average, VOO's dividend yield is 1.11%. Okay, this is their dividend yield. This lets you know how much you're being paid on your investment. All right, don't worry, I'm going to show you guys how that will be calculated. Just hypothetically, if you just put $25 in there and that's all that you did, I'm going to show you how to calculate those numbers. So let's break down those dividend numbers really, really quickly. Okay, so the dividend yield, and I'm going to show you guys. I want you to write this down so you can use this across the board, okay? So the VOO has a 1.11% dividend yield, and you have $25 invested. You're going to do $25, okay? You're going to multiply that times that 1.11%, which is what, 0.011, and that's going to give you 0.27 cent. But I like to round stuff up, so let's just say 28 cents. Okay. Now, what is 28 cents? That is the yearly amount that you're paid out in dividends. Okay. Now, keep in mind, VOO is a $635 ETF at this moment. So $635 to your 25, you're not being paid out the full dividend. You're being paid out a fraction. Okay, so just because you have fraction of shares, that does not mean you don't get dividends. You just get a fraction of the dividend. So this is the annual amount. VOO pays out quarterly dividends. So if you're getting paid out dividends quarterly, based on everything that we've calculated here, you'll see approximately 7 cents in dividends paid out every single quarter. Okay, that's just hypothetically with this 25, but remember, we're increasing it every single week. So you will see an increase in your dividend as you invest more into this particular stock. Okay, so it's free money. Don't let that small amount just be like, oh, what is that? No, we are compounding this thing. Dividends really stack up. Now, you can do one or two things. You can either reinvest those dividends or you can just let them sit until you have up enough that you want to maybe cash out. Solely up to you. Let's take all of this off. You would pretty much use this same little formula here across the board. Okay, for any stock that pays dividends. Another thing to remind you guys, not all companies pay dividends. Some companies decide to reinvest their profit. Dividends are only paid out when a company is profitable and they want to share those profits with their shareholders. So to get that formula to you guys again, to make sure you're able to use this when you see this with any company that you decide, how much dividends could I potentially get paid? So you can always look up what a company's dividends are, like look at what they're going to be paying out, what's the estimate, or if you are not planning on getting a full share, then sometimes you got to do a little bit division, a little bit addition, do a little bit of arithmetic to kind of figure out what your potential dividends would be if you're only getting a partial share. Okay, so just remember that 25, and we multiply that times that 1 point. Let me take that back off. We got 1.11%, and that right there just translates to that, and then we get 0.27, and we rounded that thing up to 0.28 cents. We divided this by 4, okay, because they pay out in quarterly, and so that's 4 different payments, and that will be 0.07. All right, that will be the final number. So it's small, but it compounds. So now that we've gotten that out of the way, now you have a slight understanding of how you can do this thing. In order for you to get to that $20,000 in 5 years, remember, investing is a long game. And so from year 1 to year 5, you have the ability to invest a total of $20,800 into the market by starting small. $25 going up to $50, going up to $75, taking this thing to $100, and going to $150. You don't have to skip $125 if you don't want. But I just kind of like by year 5, we should be able to take this thing up a notch. We should be at a point where we feel comfortable enough that, all right, I want to put in more. I see what this thing is doing. I see that my investment is growing. And that's why I said this amount here is not the final amount. Now, it could be more, it could be less. Remember, this is the stock market. It goes up and it goes down. The important thing is that even when you see some drawdown, you're not getting scared. You're getting tricked out your spot. You're selling off your stock. And then next thing you know, this thing goes back up. You have to be patient with your investment. If you do not have to ever touch your investment, don't. Let it sit for a year. Build up your tolerance to see this thing down 5%, to see your investment down 10, 15%, because at some point it's going to rebound and it's going to recoup. Remember, these are ETFs. These are not individual stocks. So therefore, there's a little bit of cushion there on its volatility and it's, having these massive swings throughout the year. So allow the drawdown to happen, but don't touch your investment. Okay, so that right there for a 5-year plan, the end goal would be to have 20,000 plus invested. And if the market is going up significantly, this thing could be, let's just say, I'm not going to go too high and be like 30, 40, $50,000, but this thing can increase to 21, to 22, to 24, to $25,000, all because you let it sit. You let those dividends from this investment kick in, you let them stack up, and you're just building your wealth over time. And you will be able to look back and say, I started this entire thing with just $25 1 year in, and then I got to year two. I took it a step up in year four, and then I went crazy in year five. And this right here will be your game plan and your blueprint and your starting point to get your investment journey going. All right. So I hope for those of you who are new to investing on the stock market that this thing was something that can really help you get started. It does not take much. And if you have kids, you can also open custodial account. So let's just say you do have $50 and you decide you want to invest $25 in your own personal account and $25 for the kid or kids. Now, if you got multiple kids, I say just put it together. But hey, do it how you want to do it, all right? Because this right here would really grow over time, and you will really look back and you will think, all right, take the time to go and look at all of the companies that I showed you guys, or ETFs, VOO, SPY, VTI, and QQQ. These are ETFs. And then you can take the time to also look at some individual stocks, things you use every day. Meta, Amazon, Apple, Microsoft, okay, Tesla. I know everybody's feeling about Tesla right now, but hey, go and look at these companies: McDonald's, AT&T, Verizon, Kruger's, Target, Walmart, Dollar Tree, Dollar General. I mean, the list goes on and on, y'all. Steve Madden, if you will. There are plenty of things that you can look into, but remember to sort of focus on ones that have the potential to have massive growth as well as pay out dividends so that you're seeing your investment move a little bit faster. All right. So with that, I will see you guys in the next one.